Happy Saturday. My name is Caleb Hammer, the guy who was wrong, and this is your week in money. We were wrong with this last Thursday, and I'm sorry. In the episode, a report came out this week, and it looked like housing prices might actually start getting cheaper. Guess what? Reports always change. And then yesterday, a new report came out. So let's get into that. In May, home prices reached an unprecedented high, driven by limited housing inventory that continues to fuel bidding wars in certain markets. According to the National Association of Realtors, or NAR, the national median existing home price increased by 5.8% from the previous year, hitting $419,300, the highest figure recorded since data collection began in 1999. It is important to note, though, that these prices are not adjusted for inflation. Either way, the combination of high home prices and elevated mortgage rates has resulted in a slowdown in home sales during what is typically the busiest season for real estate. Sales of previously owned homes fell by 0.7% from the previous month, reaching a seasonally adjusted annual rate of 4.11 million, marking the third consecutive month of a decline. On a yearly basis, existing home sales, which, reminder, constitute the majority of the housing market, dropped by 2.8%. So despite the decreased demand, home prices are climbing because high mortgage rates are discouraging potential sellers from putting their homes on the market, leading to a lower than usual supply. Additionally, sales of higher priced homes are increasing at a faster rate than those of mid-priced or affordable homes, which is contributing to the rise in the median price. Lawrence Young, the chief economist at NAR, described the situation as somewhat of a strange phenomenon, noting that although home sales activity is low, prices are still setting records. Affordability is a challenge, he said, further highlighting the difficulties many buyers face in the current market. The decline in home sales was less significant than anticipated, as the economists had predicted a 1.4% decrease, but the actual drop was slightly smaller. Good luck buying a house this year, everyone. But what do we need to have happen to make it more affordable? An economic collapse? This next story is going to be upsetting for anyone hoping for that anytime soon. Business activity in the United States showed continued growth in June, as indicated by surveys of purchasing managers released on Friday. The S&P Global U.S. Composite Purchasing Managers Index, or PMI, which measures activity in both the manufacturing and service sectors, rose slightly to 54.6 in June from 54.5 in May, reaching a 26-month high. And to be clear, a PMI above 50 signals expansion in private sector activity. The upturn is broad-based. A rising demand continues to filter through the economy, said Chris Williamson, an economist at S&P Global Market Intelligence. And this is in contrast to Europe, who experienced an unexpected slowdown. Unexpected to who? Because the Eurozone's composite PMI fell to 50.8 in June from 52.2 in May, indicating a slowdown in economic activity, particularly in France, where nobody works. And why? Well, the most recent news there shows political uncertainty surrounding surprise legislative elections in France that has led to a decline in new orders, negatively impacting the region's economic recovery. Is this actually why? It's hard to say, but that is at least what's in the news and what's currently happening now. And in Germany, which has the Eurozone's largest economy, business activity continued to grow but at a slower pace. Germany's manufacturing sector has struggled due to weak global demand and high interest rates, which have shifted consumer spending away from goods to services. I hope this doesn't mean they start forcing factories in the Rhineland to start making things again. Now, bringing all this together, the European Central Bank will likely be concerned by these signs of a slowing recovery. The ECB recently lowered its key interest rate, but suggested that future rate cuts would be gradual, partly based on an optimistic forecast for Eurozone growth this year. Meanwhile, the UK saw a slowdown in business activity as some purchasing decisions were deferred ahead of the upcoming general election on July 4th. The UK's composite PMI fell to 51.7 in June from 53 in May. But let's go to the other side of the world. Japan's private sector activity stalled despite an uptick in manufacturing. India saw renewed momentum with both its services and manufacturing sectors picking up after a May slowdown. Down under, the Australian activity also continued to grow, but at a slower pace due to high interest rates. Let's come back home. Inflationary pressures in the United States showed signs of easing in June, and businesses reported the slowest increase in prices charged in 5 months, and the cost of raw materials and and other inputs also rose at a slower pace. This overall comprehensive picture highlights how political and economic factors are influencing business activities different across major global economies. But speaking of the United Kingdom, let's talk about how shit sucks there. Now, I know we all want to see some rate cuts and make borrowing cheaper again, but sorry you Brits, that's not for you just yet, because the Bank of England has decided to maintain its key interest rate at 5.25%, the highest it's been in 16 years. This decision comes despite the central bank signaling it might soon join other European banks in lowering borrowing costs. And this decision aligns with market expectations, as most investors and economists predicted the Bank of England would keep the rate steady. Notably, 2 out of the 9 Monetary Policy Committee members voted for a reduction to 5%. Now, while the Federal Reserve in the United States is not expected to lower its rate soon, several European central banks have already reduced borrowing costs this year. Switzerland's central bank, for example, cut its key rate for the second consecutive meeting following the European Central Bank's reduction on June 6th. Now, this is despite the UK's annual inflation rate falling to the Bank of England's 2% target in May, but the central bank remains cautious. The decline in inflation has largely been due to falling energy and food prices, which the Bank of England does not expect to continue. The central bank is concerned that rising service prices and rapid wage increases could push inflation above the target again in the latter half of this year. But the Bank of England does predict inflation will stabilize around its target toward the end of next year as wage growth slows. However, policymakers want more evidence before considering rate cuts. They'll reassess the situation in August when the new forecast for growth and inflation will be published. According to the Bank of England, some committee members are increasingly inclined to support a rate cut. The record of the recent meeting indicates that the decision to maintain the rate was finely balanced for some members. And to put all of this into context, their decision comes just before a general election on July 4th, offering little political relief to the ruling Conservative Party, which trails behind the opposition Labour Party in polls. Just like the United States President Joe Biden, UK Prime Minister Rishi Sunak has not seen much political gain from the easing of inflation, as many citizens face rising mortgage costs due to high borrowing rates. But many economists anticipate the Bank of England might lower its rate at its next meeting, but some suggest a wait until November, given the modest slowdowns in wages and service prices. The Bank of England has emphasized that the upcoming election did not influence their decision to maintain rates. The UK's economic condition is weaker compared to the United States, particularly necessitating more support from lower borrowing costs. I mean, just look at their GDP. It's been basically flat since 2009, along with most of Europe. Not you, Germany. I see you. Don't get too excited again for the third time. The UK economy returned to growth in the first quarter after a contraction in the latter half of the previous year. However, recent data indicated no growth in April. The Bank of England acknowledged that the economy seemed to have grown more than expected in the first half of the year, while also noting that wage growth and other inflation indicators have moderated. In the end, this mixed economic backdrop leaves the timing of a rate cut uncertain, with the Bank of England closely monitoring further developments before making its next move. Any Brits out there? Let me know in those comments below. Alright, let's get into your weekly market updates. Markets this week continued their gains despite the holiday week. For the S&P 500, week over week we're up 0.61%, year to date we're up 15.22%, and year over year we're up 25.17%. The Dow Jones week over week we're up 1.45%, year to date we're up 3.8%, and year over year we're up 15.31%. Gold week over week we're down 0.45%, year to date we're up 12.61%, and year over year we are up 16.56%. Oil week over week we're up 2.6%, year to date we're up 14.52%, and year over year we're up 11.13%. Now for some movers, Dell is proving itself a player in the AI game and is up 7.59% this week thanks to a new partnership with Elon Musk and Grok. Chewy adds onto this list of massive gains this month and is up 14.95% this week. SiriusXM has seen benefits from a reverse stock split and is up 12.64% this week after a very lackluster year. Here's a quickie for your Saturday, because I know you ain't getting any. The Supreme Court has upheld the current federal tax rules regarding certain international investments, confirming that Congress can lawfully tax income earned by foreign companies, even if that income hasn't been distributed to American shareholders. This ruling preserves the 2017 legislation that introduced a one-time tax on accumulated foreign profits and avoids the potential legislative complications that could have arisen if the court had invalidated this aspect of congressional taxing authority. The ruling issued on Thursday of this last week specifically supports the provision from the Tax Cuts and Jobs Act of 2017 that imposed this tax. This decision reassures lawmakers about their power to tax foreign income, which had been challenged on constitutional grounds. Critics of the tax argued that it violated the Constitution because it taxed income that had not been realized by U.S. shareholders, meaning they had not actually received the money. However, the court's decision was limited in scope. It did not address broader questions about the extent of congressional taxing powers, such as whether income must be realized before it can be taxed, or whether the Constitution permits taxes on wealth or the value of appreciated assets that haven't been sold. These unresolved issues leave room for future legal debates and potential challenges. And this ruling has significant implications for the taxation of international business operations and for the broader debate about how the United States tax system handles foreign income. It underscores the complexity and ongoing evolution of tax law as it adapts to the realities of a global economy. Next, Paradromics, a neurotechnology startup, is nearing ready to test its brain implant next year as competition in the brain-computer interface, or BCI, sector intensifies. This trial will position Paradromics against companies like Neuralink, which recently implanted a chip in a patient's brain, but unfortunately Neuralink did face setbacks when part of the implant malfunctioned shortly after the procedure. The brain is incredibly complex, with about 85 billion neurons, each significantly slower than a computer chip, yet it accomplishes remarkable feats, explained Matt Engel, CEO and founder of Paradromics. He emphasized that to effectively interface with the brain, technology must simultaneously communicate with numerous neurons, leading to the development of high-speed, high data rate devices. So, Paradromics. They were founded in 2015, they raised $87 million in venture capital and an additional $18 million in public funding. The company is based here in my town, Austin, Texas, and they expect its brain implants to be priced around $100,000 each. Our mission is to convert severe brain health conditions into solvable technological challenges. We're fundamentally designing a medical device to address unmet needs, Matt Engel said. Initially, Paradromics will focus on patients who have lost their ability to communicate due to conditions like paralysis, ALS, or spinal injuries. We've chosen to prioritize motor and speak functions because these areas are well researched and the science is established, said Paradromics' chief scientific officer. He also noted that the implant would be wirelessly powered, eliminating the need for charging, and users would undergo a brief calibration routine to map electrical signals to integrations, after which the system would be fully operational. Matt Engel is optimistic about obtaining commercial approval for the product by 2029. He anticipates that the initial million users of brain-computer interfaces will seek treatment for severe medical conditions. In the future, possibly 20 years from now, these devices might also find consumer applications. For now, our focus remains on creating safe, reliable, and robust devices for individuals with physical and mental health challenges. Would you ever get one of these from Paradromics or Neuralink? Let me know in those comments below. Thanks for sticking around this Saturday morning. I'll see you all Tuesday.